Look at those graphs. Profits are skyrocketing just as planned. Oil prices up, markets up, profits up. Excellent. It's working perfectly.
On April 7th, Donald Trump announced a ceasefire with Iran. And the very next day, the stock market had its best day in nearly a year. But here's the part nobody told you. The war wasn't actually over. So why did markets rip? And who made billions while you were confused? I'm going to show you exactly what happened. But first, you need to see what Wall Street looked like before that announcement, because that's where the real story begins. Go back to February 28th. The U.S. and Israel launched joint airstrikes on Iran. Supreme Leader Khamenei was killed. Then, Iran did something that sent shockwaves through every financial market on Earth. They shut down the Strait of Hormuz, and the market started bleeding. By the end of March, the S&P was down nearly 9%. Your retirement account was quietly screaming. But underneath the surface, something far more terrifying was happening on Wall Street. Hedge funds weren't just repositioning. They were selling at the fastest pace in 13 years. But how do we know that? Because one firm had a front row seat to everything. Goldman Sachs runs what's called a prime brokerage desk. They service most of the major hedge funds on Wall Street, which means they see exactly what these funds are buying, selling, and how leveraged they are. Q1 hedge fund selling in North America, largest since April 2020. Gross leverage over 300%, near all-time high. Short exposure to macro ETFs like SPY and QQQ, highest since the pandemic. Now, here's where it gets scary. Because in March, a commodity analyst said something on camera that almost nobody was paying attention to. He said the disruption was bigger than anything in history, that every serious analyst he spoke to was terrified, that if the strait stayed closed, we'd need to shed 15 million barrels a day of global demand. Brent crude, $250, $300 a barrel. And recession? He said that word was too light. We're talking depressionary. So with oil markets on the edge of collapse, hedge funds panic selling, and analysts predicting a depression, what happened when Trump announced a ceasefire? The next morning, it was like someone turned the money printer back on. 400-plus stocks in the S&P finished green. Brent crude dropped 13.5%, biggest single-day decline since April 2020. WTI crude fell over 16%. Headlines called it a relief rally. Peace was here, crisis over, except it wasn't. According to maritime intelligence firm Windward, which uses AI to track real ships through satellite data, only 5 outbound carriers were detected through the strait by midday. That's a 96% decrease from normal traffic. The ceasefire was falling apart in real time, and yet stocks kept going up. So if it wasn't peace moving the market, what was? A short squeeze. And I can prove it. Here's how it works. When you short a stock, you borrow shares and sell them, betting the price drops so you can buy them back cheaper and pocket the difference. But if the price goes up instead, you're stuck. You still have to return those shares at a higher price. And if the price keeps rising, your losses keep growing until your broker sends a margin call, add more money, or close your position. Now. When enough people get margin calls at the same time, they all rush to buy back shares simultaneously. That buying pushes prices up, which triggers more margin calls, which triggers more buying. That's a short squeeze. And on April 8th, with macro short exposure at its highest level since 2020, the squeeze began. But the squeeze was just the first domino. Because once stocks started ripping, the robots woke up. Meet the CTAs, Commodity Trading Advisors. These are systematic trading firms that run on pure rules-based models. They don't care about news. They don't care about geopolitics. They just follow trends. Trend down, short. Trend up, long. That's it. Goldman, CT has held approximately $30 billion net short going into the ceasefire. The second the S&P crossed trigger levels, models flipped, not to neutral, but to aggressively long. Goldman originally estimated they'd need to buy back around $40 billion of equities. The actual number, $86 billion across just 5 trading sessions. Goldman called it a top 5 buying speed print of all time. But we're still not done, because there was a third domino: the options market. Dealers on the other side of options trades have to stay delta neutral. They hedge by buying the underlying stock whenever customers pile into call options. A data platform called Spot Gamma had flagged a negative gamma regime heading into the ceasefire. That's the regime where dealer hedging goes from stabilizing to turbocharging price moves. Price goes up, leads to dealers buy more leads to price goes up more. So what we actually saw on April 8th was a short squeeze, plus a systematic CTA flip, plus dealer hedging. 3 dominoes falling one after another. That's the rally. Not peace, not relief, it's mechanics. Now here's what makes this really unsettling. Because this isn't new. December 2018, markets crashing. Powell says one word: patient. Dow gains 1,000 plus points in a day. First time ever. August 2024, Bank of Japan hikes rates for first time in 17 years. Yen carry trade unwinds. Nikkei drops 12% in a day, then bounces 10% the next. Different catalysts, same exact mechanics. And here's why this keeps happening. Because the market has fundamentally changed. 20 years ago, humans ran this market. Portfolio managers, analysts, people reading earnings reports and deciding what a company was actually worth. That market is basically gone. Today, 63% of all U.S. stock funds held by passive indexers, over $13 trillion of money that doesn't read earnings, doesn't care about geopolitics, just blindly follows the index. And because passive funds are market cap weighted, the bigger a company gets, the more they buy. That's how the Magnificent Seven now makes up over 33% of the entire S&P 500. What's left of active investing? Giant multi-strategy hedge funds, running at 4 to 8 times leverage with automatic drawdown rules. They don't debate, they just sell. Same-day expiration options, 63% of all S&P trading. On peak days, over $2 trillion, notional changes hands in a single session, every single one forcing a dealer to hedge in real time. The dominant players in 2026 aren't analyzing valuations, they're reacting. And when price moves, their reactions stack on top of each other. That is the market you're investing in. The stock market we grew up hearing about, finding undervalued companies, investing for the long term, that version is gone. What's left is a giant feedback loop of algorithms, passive funds, and options dealers all reacting to each other in real time. And the headlines? They're just the stories people use to explain something they don't fully understand. If this video gave you a clearer picture of how the market actually works, the loops, the mechanics, the game happening behind the headlines, hit that subscribe button and drop a like on the video. And comment below. I want to hear your thoughts.